Hey, what's up everybody? Welcome back. In this tutorial, I'm going to show you how to use moving averages like a boss. You heard me, like a boss. And this is one that gets, quite a lot of confusion for good reason. I'm going to help piece this together for you. And by the end of this video, I'm sure it will make a whole lot more sense to you. Right here, I have 3 different moving averages, and these can work on any time frame. If the thought of time frames is confusing you, you're not alone in this feeling. It's fucking confusing, right? The best way I could simplify using moving averages on multiple time frames or any indicator is you gotta look for patterns. It doesn't matter what time frame it is. If you can spot a pattern relative to a moving average, you're onto something. I don't care if it's a 5 minute, the 1 hour, the daily, the weekly, the monthly. So right here, I have the 3 staples: the 20 day, which is the green line, the 50 day, which is the red line, the 100 day, which is the gold line. I would also include a 200 daily moving average because that one is a fucking absolute beast. But since we're in a bull run right now and very far from the 200 daily moving average, I'm not going to use it at this moment for this particular stock. So let's just be practical here and, try find some patterns that have happened in history and where we would have gone long or short. Okay guys, in a bull run, the 20-day moving average is your best friend. I like to make my trades on points of contact with the moving averages, like this. I'll even include this when you hug the moving average. It's a great time usually to get into a trending stock, because the thing about the 20-day moving average, if you're in a trending stock that is on a clear uptrend trajectory, you know for certain, I don't care what stock this is, coming down to its 20-day moving average is the most natural thing that can occur and that will occur. Moving averages are lagging indicators, and the faster the moving average, the less of a lag there's going to be. So naturally, because Tesla has shot up so high so quickly, the shorter moving average is going to follow this price more closely, something like that. Whereas this longer 100-day moving average, it's probably going to move more like this, So the chances of it touching the 20-day moving average is a given. It's going to happen no matter what you think about the stock. So once again, looking at this 20-day moving average on a trending stock like Tesla, if you bought any time at the contact of this 20-day moving average and waited it out till you're in profit and then sold while you're in profit or put a trailing stop loss in profit, you would be laughing. Here's a great example. Say you bought at the point of contact of this 20-day moving average. It dipped down a little bit, but if you hold on for a few days, you could have set your trailing stop loss in profit. And depending on how well you've mastered your emotions in this game, you could have potentially walked away with a lot of money. Literally, if you bought this stock any point in the last few months at the contact of its 20-day moving average and waited out the storm, which is basically just a few days, and you took your profit when you were in profits, you're doing well. Now, the tricky part about moving averages is just like it can act as strong support, the exact opposite can happen for downtrending stocks. Like I mentioned with Genus, and like I'm going to show you right here with ACB. With the 20-day moving average on the daily, I usually like to see 3 bounces to confirm a trend, to confirm the probability of the trend. So 1, 2, 3. At this point right here, I would have entered into a long position. You had ample time at this point to take your profits or set a trailing stop loss in profit. Here's where it can get tricky. When the trend runs out of steam, because patterns are only patterns while they're still going. Sometimes these patterns run for a long time, sometimes they run for years, sometimes they run for a few weeks. Playing swings and bounces like this, all you need to make sure is that your winning trades outnumber your losing trades. Okay, it's as simple as that. So say we predicted this bounce right here, and we're not greedy. We've mastered our emotions. We know exactly when we need to sell. When you sense that self-destructive feeling of greed, having more than you even expected with this trade, that's when you set a trailing stop loss in profit or just cash out. So say we entered this trade around here when the bounce became more probable. We had almost up to 30% upside where we could have taken our profits or set the trailing stop loss, okay? So we nailed that trade. Here we decided to play long again, but keep in mind, I don't go balls to the wall with hype stocks like ACV. I only ever play options on them, risking smaller amounts of money for a bigger piece of the pie, a bigger return. By this point, it looked like it was going to bounce again. It made contact with the 20-day moving average, and we did the same thing. We entered into a long position, but instead, the trade went south. And this is when you wait, because time tells everything when waiting for the right plays. Let's wait for 3 solid interactions with a moving average to predict the direction of the overall trend. Here's the first rejection from the 20-day moving average. We come up again, second rejection. We come up for a third time, third rejection. At this point here, after the third rejection, we come up another time to meet this 20-day moving average. At this point, I'm going short. The price has been rejected from this green line 3 times. And on the 4th time, I'm going short. I'm going in the direction of what the pattern is telling me. I'm going short from this point. I could have taken my profits, or I could have held on. Anytime the price reaches this area of this specific line, I am going short. Boom. Here is a perfect example. It touched the moving average and it absolutely dumped. This stock in specific, ACB, has done this for a long time. And at the moment, potentially we are seeing a reversal of this thing when the 20-day moving average starts acting as support instead of rejection, okay? But we are yet to even experience our first bounce off this moving average. Time will tell. It is way too early to figure out or to enter a trade at this point right here, in my opinion. Give me 3 bounces and I feel way more confident. Let's go back to Tesla. Now guys, take everything I just told you about the 20-day moving average and apply it to all the other moving averages. Now instead of the 20, let's use the 50. By the way guys, you can use any moving average your heart desires. For me, I stick with the most popular, universally used moving averages, the 20, the 50, 100, and the 200. Anything below the 200 daily moving average is considered long-term bearish, and anything above the 200 daily moving average is considered long-term bullish, which is why a lot of the time when a stock gets down to the 200 daily moving average, there is a very strong bounce off that region. If it's a good stock and it's crashing because of news, but at the core, it's a good company, it will more than often bounce off the 200 daily moving average. That's why it holds so much weight. Yeah, you can apply everything I told you about the 20-day moving average and apply it to the 50-day moving average. It is the next line of support. I love opportunities like this. When 2 different moving averages, in this case the 20 and the 50, are so close to each other that if you think about it, the support becomes way more stronger. Because if you think of the 20 and the 50 each holding a certain amount of weight and support, when they're close together and sandwiched together, in my mind, that's just reinforcing the support. So this would have been a great time to play and just, wait it out. I definitely would have gone long here. And look what happened. This whole time, we followed the 20-day moving average. Boom. And look guys, let's just keep the 50 here. If you don't believe in moving averages, how do you explain this? Is that just coincidence that we came down to this 50-day moving average to the T and bounced off it? That is a beautiful swing right there. Let's just zoom in to a T, guys. Look here, what do we have here? This looks like a pattern of rejection of the 50-day moving average. Let's look for 3 interactions. First interaction, hard rejection. Second interaction, hard rejection. Third interaction, what do you know? By this 4th attempt, you best believe it, I'm going short. Boom. If you're playing a put option on this, like I would have been doing, I'll show you the final product is not going to be 14%. It could easily be double your investment. Depending on your expiry date, okay? There are certain things to keep in mind, but for the most part, options trading is a lot easier than people try to make it out to be. So that's one trade where we pretty much doubled our money through put options. Look here, we come up for yet another attempt. What do you think I'm doing here? Do you think I'm going long or do you think I'm going short? You best believe it, I'm going short again. And I'm doubling my money again through options. This is where it gets tricky. It is hard to count this as an interaction, but it is. At a point like this, a good play, instead of going short in this area right here, would be to add a little bit of support into this. If we broke this level of support, here would have been, a nice time to go short. This is 3 trades where I've doubled my money through put options. What do you think I'm doing here at this point? You think I'm going long or short? You best believe it, your boy is going short. But look what happened. The trade failed. But keep in mind, we just came off 3 winning trades and we have 1 losing trade. We're still flying in profit, guys. And when this pattern finally breaks, let's wait for 3 interactions to determine the next direction of our move. Here's your first bounce, second bounce, third bounce. What do you think I'm doing at this point? I'm going long, baby. There you go. Let's go to another trending stock. NIO has been on a fucking tear recently, okay? Guys, just straight off the bat, I don't think I need to even say anything. I'm pretty sure you guys can already see the picture. You can already see the pattern forming here and when the best times to get into the stock are, just by looking at this straight away. Within 5 seconds, you know what's going on here. Take this away, you're driving blind. That's how I feel. Of course, I could use lines of support and resistance, which are very, very helpful. This is how I would convey stock trading. It's not one indicator. It's not just one factor. There are so many different factors. So why not use your entire arsenal? I just drew this in a level of support. Why not use all the tools at your fingertips to predict the best possible outcome? So say you were just using this line of support here and you were deciding where is a good time to buy and you weren't feeling too confident just relying on this line of support. You add the 20-day moving average because we're still in a clear uptrend. The closer the price gets to this green line, the better buying opportunity you have on your hands. Probability wise, just keep that in mind. And it is interesting to me that at this official point of contact, guys, I did not pre-plan this video. I literally just chose these stocks at random and instantly playing off what I see. It's just not mere coincidence to me that, it decided to pump on this day. Sure, maybe it is. Maybe there is news that came out on this day. I don't know. But look at that. You have support that you drew in manually by means of a simple line of support. And on top of that, you have an added level of security, an added confidence booster to go long. Flying blind, and this is flying smart. I could go on all day, guys, choosing different stocks, but I think I have done a decent job of explaining the theory behind it and showing you how it works and how you implement this and how you use your time and your patience and your greed. That's all up to you. I would definitely encourage you to add moving averages to your arsenal because you're kind of pigeonholing yourself by just relying on a limited amount of tools. Playing moving averages like this is definitely one of my strengths. I want us all to prosper from this. Thank you guys for watching. Please subscribe for more videos. Peace out.